Hello everyone, I'm Sabina CPA. I'm the founder and principal of Bay CPA Plus. We advocate less taxes and more profits. In my latest blog post, I discuss the best tax-deferred retirement plan for freelancer, self-employed, and small business owner. As the picture is worth 1,000 words, instead of rehashing what I wrote in my blog post, I would just present the picture here. The blue bar is SEP, which means Simplified Employee Pension. The orange bar is Simple IRA, and the gray bar is the 401k. As you can see, as your income grows, because of the structure of each retirement plan, your contribution is determined or limited by your income. So let me just walk through high level what are some of the pros and cons, and for whom each of these options is best for. For SEP, it's actually best for freelancers who don't have any employee, best for people who are self-employed, or small business owners who do not have the W-2 to themselves. Because SEP is a turbocharged IRA, it's the easiest to set up and maintain, and you probably find more financial institutions being available to help you set one up. You can buy the same investment as regular IRA, such as stock, bonds, mutual fund. Freelancer can contribute up to 25% of their net self-employment income, up to a maximum of $57,000 in 2020. So that's quite substantial if you have a lot of freelancing income. And the SEP is flexible. So if your cash flow is not as stable from year, and you don't have money to contribute one year, you simply do not contribute. And for freelancers who are moonlighting, SEP has no extra contribution limit if you max out your 401k at your other job. The con is that the SEP will not have the catch-up contribution. So if you're age 50 and older, it may not be as beneficiary. Secondly, if you pay yourself W-2 in your S Corp to limit your self-employment tax, your SEP contribution will be limited too because it's based on your salary level. And if you incorporate your small business and you have employee, you would have to contribute for them as well if you set up a SEP. Now let's move on to Simple IRA. It's best for part-time or sideline business earning less than $54,000. The pro is that this is another turbocharged IRA like the SEP, so you're easy to set it up, and it's the simplest to administer. You and your employee can defer and deduct 100% of your income up to $13,500 if your income is under $54,000. This may be more than you can sock away with SEP, because remember, SEP is 25% of your income. So in this case, you can have more contribution. And if you're 50 and older, you can make an extra $3,000 catch-up contribution. The con is that if you have employee, you have to match everyone's deferral or make a profit-sharing contribution. And the catch-up contribution limit for Simple is $3,000 versus $6,500 in solo 401k. Lastly, in this latest blog post and today's video, I would discuss solo 401k. This is the best option for small business owners who want to contribute more to their retirement, because as you can see on the graph, depending on your income level, you can contribute more than the other two options. And especially good too if you operate your business all by yourself with no employee other than your spouses. And you can establish it with less red tape. I'm talking about solo 401k versus a regular 401k. And 401k in general are good because it's a more structured incentive and benefit plan to attract and retain talent for a more mature business. And then also for any business owner who want to get tax credit for setting up a retirement plan, a 401k is the way to go. So let me go through some of the pros. Tie back to what I said earlier, if you have more income and you can contribute more, 401k lets you save more or at a later stage in life. And your catch-up contribution for age 50 and older, you can catch up at $6,500 in 2020, plus all the contribution you make, you can bring the total employee contribution to $26,000. And the second thing about 401k is that it lets you not only contribute far more money, but you also offer more flexibility than either the STEP or the simple plan. You can offer yourself and your employee loans, hardship withdrawal, and all the bells and whistles the big company offer their employee and their 401k. And as I said earlier, you can receive tax credit to set up a 401k. Tax credit is essentially a government subsidy because they want you to contribute to your own and your employees' retirement plan. So they give you a break. So it's tax break. The con for 401k is that for solo 401k, fewer financial institutions offers it. And then you also have to be careful about fees. And as 401k are true quote-unquote qualified plan, which make them harder to administer than SEP or simple. You have to draw up legal paperwork to establish a qualified plan, trust, and the trust has to file Form 5500, which is information and return reporting the contribution asset every year after the asset reaches $250,000. And then there are complicated anti-discrimination and top-heavy rules to keep you from stuffing your own account. And I've been getting some questions regarding what are the options for highly profitable business owner who want to contribute more than the $57,000 that we discussed here. And also question of whether there are truly tax-free retirement options. And I will discuss those in part 2 and part 3. So sit tight. At the same time, if you find this information useful or you have any more questions, please contact me. And please feel free to forward this along to friends and family who are considering planning for their retirement. Good luck and talk to you next time.